Good morning from London. I'm Kriti Gupta alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. It's the countdown to Donald Trump's, quote, Liberation Day, dampening risk appetite from stocks to bonds to gold. People are nervous. Meanwhile, in China, President Xi Jinping vows to improve market access to the country at a meeting with global business leaders in Beijing. Plus, a Bloomberg scoop, a draft document reveals that the U.S. is seeking to control investment deals in Ukraine, squeezing out European allies as the continent attempts to create a peacekeeping force. Guy.
Good morning. How are you feeling, Kriti? How are you feeling out there? We have got an interesting session coming up. PCE data is going to come a little bit later on. But let me give you a sense of kind of where we are going into this Friday session and into next week as well. Euro Stoxx 50, down by 0.5%. S&P, it's been down for the last two sessions. Yeah, tech's taken a bigger hit. It is down again today. The Nikkei got absolutely thumped overnight in Asia. Pay attention to that trade. Where are you hiding? Well, this morning, you're hiding in gold. Once again, a fresh record high for gold. The countdown to the opening trade this Friday starts right now.
We will fight the U.S. tariffs with retaliatory trade actions of our own that will have maximum impact in the United States and minimum impacts here in Canada. We will protect our workers and our industries during this difficult period.
Mark Carney amping up the pressure ahead of next week. It's interesting, the Canadians have decided not to retaliate now to the car tariffs. They're going to wait. Carney's going to wait until next week. We're all going to wait, Kriti, until next week. Next week's fascinating. You've got not only the tariff story, but you've also got payrolls data coming up on Friday as well. The market, I think we caught it at the back end of the session yesterday in the States. Definitely, I think this morning, the market's going to kind of be in wait-and-see mode now, I think. Do you want to take big risk into a weekend that has such potential big risk on the other side of it?
Well, not just into the weekend, but into Tuesday, right?
Yeah.
Do we really see everyone wait until Wednesday and arguably even until Friday, to your point, to that payrolls report? The math here is interesting because on the one hand, how do you even calculate what a reciprocal tariff includes? We know that Donald Trump and his administration has talked about non-tariff barriers. I don't know how you put an amount on things like regulation out of Brussels or VAT, et cetera. So that kind of math is challenging. And then when it comes to the markets itself, do you then price in a premium for how much risk you can take if you are trying to buy into a company that, for example, has more tariff risk, or do you do the opposite? Do you sell out of those companies?
What I don't know is where expectations are. We've had the car tariffs. That's obviously thrown everybody a loop. Everybody's worried as a result of that. I've heard all kinds of theories this morning. Val was the latest one to give me another one. But there's all kinds of theories floating around out there about the strategy behind what Donald Trump is doing. I'm assuming there is a strategy, and whether or not actually these tariffs are going to be maybe below expectations. And what happens then? Is the market actually, after a few down days, primed to go pop back up again if actually things, risk assets, if things turn out to be a little bit more benign, maybe on the tariff front?
Is it fiscal policy, though, that's in charge, or is it monetary policy at the end of the day?
Well, that takes us on to Friday, which is the payroll number. So I've seen the whisper number, which I think is in the 70s. The survey number is kind of 140, 137, 140. What happens on that print, I think, is going to be really interesting. So even once you get through the tariff narrative, Tuesday, Wednesday, you've then got payrolls to think about next week, back end of next week as well, which is another huge risk factor around how pricing is going to be positioned.
I'll add the other piece of this is how quickly then do leaders around the world not just need to have some sort of answer to Donald Trump, but have some sort of answer to investors to bring investment back into their countries.
Well, you're taking me all the way to China, aren't you? We've seen the Xi meeting that has taken place today. You've seen the CEOs of Astra, Sanofi, Ray Dalio was at this meeting. 40 CEOs, 40 investment leaders at that summit. Last time it was 20. Last time it was mainly the US. This time around, a lot more Europeans in the room as well. So that's interesting as well. Clearly, he is trying to send a message that China is open and ready for business. They've already seen investment declining really sharply in China. Inward investment was already down and down hard. You've now got, obviously, the tariffs to factor into the thinking as well. The Chinese, like everybody else, is trying to figure out how they attract investment in a world that is increasingly becoming more fragmented and increasingly more risk-off and nervous.
So there's a line to be drawn between the playbook that Europe is using and the playbook that China is using, and that they have to your point, attract investment after so many international flows have left both regions. But it feels like the base case for a lot of investors that are looking at Europe or that are looking at China are looking at it from a fiscal pumping perspective and saying, well, the Chinese government is backstopping, say, some of these assets, which there was a lot of concern around when they first did it. Now that optimism has come back, it feels like we're saying the same thing about the likes of Germany and the fiscal spend there, or Italy and the fiscal spend there, that if the government is pumping money into the economy, that's where you want exposure.
Yeah. Have both markets run too far, though? Chinese tech has had a great run recently. Has that run too far? European stocks have had a great run recently, particularly German stocks have had a great run. Are earnings going to back that up? I think is the next key question that we need to watch out for. How much of a trickle through are we going to see down? Are we going to see from this German defence spend? I don't know the answer, but we've got some great guests lined up maybe to talk about that throughout the show. But I think there's some key questions about both markets from an investment perspective.
From an investment perspective and then from a defence perspective as well, which has gotten so much of the love when it comes to that European playbook, which takes us nicely to a Bloomberg scoop, actually, that the U.S.
This story is extraordinary.
It's amazing. I mean, how many times on this show have we talked about what the critical minerals deal actually looks like and whether or not we want a stake, whether we want a kind of a larger piece of this or just rights to the land and then have companies come in. Now it feels like, according to a draft seen by Bloomberg, the U.S. is pushing for a deal that would give it complete control over not only the land, but the major infrastructure rights there as well.
I don't often sort of sit here and read from Bloomberg stories, but this one is absolutely extraordinary. All major future infrastructure and mineral investments in Ukraine will be pushing. The US is pushing to control at this point. Basically, this will, if it was to succeed, if the US were to succeed to get this happen, would materially undermine Ukraine's bid to be part of the European Union. They're looking for a right of first offer. They're looking for roads, railways, ports, mines, oil and gas extraction, and of course, as you mentioned, critical materials. This is absolutely, in effect, this is the line that really stood out for me. In effect, this would mean the Trump administration would compel Ukraine to pay for all of the US military and economic support provided since the start of the war before Kyiv received any income from any of these areas. This is extraordinary what they're asking here. And you do wonder whether or not actually the European Union will find a way maybe to provide a counter-offer. I don't know, but that certainly is the Macron-Starmer plan. But whether or not the Ukrainians are prepared to sign up for this, I don't know.
Well, it's coming off the heels of this Coalition of the Willing summit that happened yesterday in Paris as well, the result of which was quite seriously that the idea that Donald Trump has considered, which is the removal or even the lifting of certain sanctions in Russia, is a non-starter for the Europeans. They're actually talking about a peacekeeping force. I thought the line in the story was interesting as well. Our colleagues in Kyiv saying that this deal, if it does indeed come to fruition, could undermine Ukraine's bid for some sort of role or some sort of membership path to the European Union as a whole. And I thought that was pretty significant. We're not only talking about the military future of Ukraine, but the economic future of Ukraine.
But the data dropping out of the UK, it's quarter-on-quarter GDP data, which in theory should be quite important. It is the more important number, but we've already obviously had a lot of the data thus far. So the quarter-on-quarter number comes through at exactly 0.1, which is exactly what the prior number was and exactly what the anticipated number was. What I think does stand out a little bit this morning is that government spending has dropped fairly sharply, which I think is interesting in the light of Rachel Reeves's room for manoeuvre here already. So that already starting to drop. Retail sales comes through. This is usually just something of a weather report, to be honest. I'm not entirely sure how much you should pay attention to this. Shopping is obviously my specialist subject. But retail sales ex-fuel month on month comes through stronger than anticipated, but down on last month. I can't remember what the weather was like. I can't remember whether we should have been buying things or not buying things.
It's all a blur at this time of the time of day.
Exactly. Anyway, let's talk about the guests we've got lined up to talk about what is happening in these markets. Modupe Adegbembo, Jefferies economist, joining us. Valerie, Genin, Barclays private bank, Monaco head of investments, is going to be joining us as well to talk through these markets and give us a perspective on what is happening. Peter Tchir, Academy Securities head of macro strategy, is in London. He'll be joining us around the table a little bit later on.
An all-star lineup, of course, on the show, and really counting down, it feels like, to Liberation Day. April 2nd is at least what the Trump administration is calling it. But before we head out to the weekend, there's plenty of data that we are expecting as well. Kicking it off, a good chunk of it actually coming on the show in the next couple of hours. A lot of Spanish and French economic data is going to be important to keep an eye on. At 7:45 a.m. UK time, we're going to get France's numbers. At 8 a.m. UK time, Spain's numbers. And this is significant because France, of course, has also kind of closed its deficit expectations a little bit. Marginally.
Yeah.
I'm going to say marginally, a little bit, emphasis on tiny. But based on what's going on, tiny, I think, is progress. And we'll take it. But, of course, I think the countdown, at least for the U.S. bond market, is going to be that PCE price index, that coming up at 12:30 p.m. UK time. Do we start to get early signs there of inflation expectations that do start to seep into the data?
Yeah, and how much should we care about what is happening with inflation? When you look at the data, should you be looking at this and saying, we don't know yet because tariffs are coming, we don't know what impact they're going to have? You heard what Susan Collins out of Boston had to say yesterday, indicating once again that she thinks it is inevitable, I think was the word that she used, that inflation will rise. We'll hear from her very shortly. So, yeah, I think you can pay attention to this data. The European data, I think, is really interesting as well. And what I think is really fascinating is that you're starting to see this real commentary emerging. So Spain, economic paradigm at the moment looks good. But it's doing really badly on defence. It doesn't spend on defence. Are we going to start to see pressure because it's doing so well on the economic side? Maybe it needs to do more on the defence side. This conversation's just beginning to start in Europe, and I wonder whether the fiscal story is going to have to change in Spain as a result of that. Yeah. If you're on the other side of the Pyrenees, maybe you feel a little bit safer. It's
fascinating because so much of Spain's kind of moment in the sun has been, we're doing really well, our credit spreads are doing really well, we're the best performing economy in Europe. But it's all relative. You're only the best performing because France and Germany were struggling. If you start to see some sort of reversal from, say, Germany's fiscal spend or stability in the French political situation, suddenly that moment in the sun isn't as shiny.
We will look... the sun always shines in Spain. What else do we need to know this morning? Let's talk you through some of the other big stories. Deutsche Bank's CFO, James von Moltke, is going to step down next year. He will be placed by Raja Akram. Akram, who is currently Morgan Stanley's deputy CFO, will join the German lender in October and take up his new role after a transition period. And Deutsche, it's worth noting, has extended its chief executive, Christian Savings, contracts through to April 2029. Lululemon shares down hard after it gave a disappointing outlook and voiced concerns about US consumer spending. The company's CEO, Calvin McDonald, says US shoppers are keeping their wallets tightly closed because of high inflation and geopolitical concerns. Inventory levels were up 9% globally compared with the year earlier. Despite the weakness, the company is sticking by its target to double sales to $12.5 billion by 2026. And CoreWeave, this is going to be a story for today, has raised $1.5 billion in a heavily downsized IPO. The cloud computing provider sold 37.5 million shares at $40 a piece. That's down from an initial plan of $47 to $55 a share. CoreWeave was an early adopter of NVIDIA graphics chips and is building out data centers to offer AI-linked computing. AI took a big hit yesterday, and it kind of feels like it's this story that we got out on, I think it was Morgan Stanley, but I could be wrong about that, on Microsoft. And it wasn't Morgan Stanley.
TD Cowen, that was
it. On Microsoft, and it felt like that resonated yesterday in the market. Just nervousness about, are we starting to see maybe some sort of pullback in terms of the AI spend narrative? And if so, how quickly can that ripple through the system?
So this, I think, is such a great example of why the hyperscalers are at the forefront of this. They have the cash to, I don't say this word lightly, they kind of throw away when they need to, because the critics of that kind of story where Microsoft is going all out on AI, they're spending a ton of money on it, and then they're pulling back piece by piece, is similar to the way they approach things like hiring, for example. They hire all this talent, and then when they need to scale in, they can scale quite quickly, or scale up or scale down quite quickly. You can't do that if you're a smaller player trying to enter AI or trying to make kind of inroads with AI. That's something that's really kind of saved for the likes of Microsoft, Google, Alphabet, or sorry.
But are they pulling back? Are they pulling back?
That's the thing we don't know. Are they pulling back because they've overdone, or are they pulling back because there's a real fundamental shift in AI? And that's the piece I can't put together.
You can understand the strategy. It gives you optionality. You may not get access to the build out if you delay, so you don't delay, and then it's easier to cancel. How aggressive could this cancelling be? I don't know. But it was interesting. Communication service got hit really hard yesterday. And we've seen 2 down days in markets. Look at the CoreWeave story. There's clearly some caution there. It's interesting. For the last few years, everybody's hit out in these big companies.
Yeah.
We're going to talk about this throughout the show. Can you do that now?
And can you do it in a IPO market as opposed to just the regular stock market where you're already listed? Can you still get that fundraising? $1.5 billion is not a small amount to look at, but still, less than expected, which says something about the valuations. We're going to continue that theme throughout the rest of the show. Coming up on the program, we're going to take a closer look at the stocks to watch at the open, including French video game maker Ubisoft. The company's U.S.-listed shares soared as much as 20% after announcing it will carve out a unit that would include some of its most popular franchises. Tencent Holdings will invest 1.2 billion euros approximately to acquire a 25% stake in the new entity. Plus, I spoke to Donald Trump's former Commerce Secretary, Wilbur Ross, about the president's tariff agenda and Doge cuts. Are they moving too fast? We're going to bring you some of that interview later in the show. But first, we are joined by Alex Jekov, head of G10 FX strategy for Europe at BNP Paribas Markets 360. That conversation coming up next. If you have any questions of your own for us, for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
It's inevitable that tariffs are going to increase inflation in the near term. And my kind of modal outlook would be that that could be short-lived with a continuation of some, disinflation, but further in the future than I might have expected before. But there are risks around that.
Boston Fed President Susan Collins weighing in on the inflation story. Inflation is inevitable, but will be short-lived. That's the takeaway from what we just heard from her. Let's carry on the conversation and fold it into the wider market narrative. Valerie has more.
Guy, we are staring at a big data print released for the U.S. today. We get PCE data dropping at 12:30. If you can change this graphic to my PCE table, maybe I can talk a little bit about it. It's my impression that the market is likely to look through any surprises when it comes to the inflation component of personal consumer expenditures and focus more on the personal spending. This comes after we've gotten another round of retailers warning on the U.S. consumer, the latest coming from Lululemon, a profit warning. Yet again, warning on the U.S. consumer. Is it too early for this to show up in the harder data? Are we going to have to wait for more clarity on tariffs? But there's one asset that isn't waiting for any further clarity, and that is gold. It has gone bananas, I want to say, since the tariff announcement on autos from Donald Trump, rising over 2%, nearing 3,100 for the yellow metal. Is this recession fears? Is it tariffs? Or is it both? It's kind of gone hand in hand with the equity market also being on a back foot. The S&P 500 is now set for its first quarterly loss since 2023 as we eye quarter end and month end approaching on Monday, a day before Liberation Day.
Valerie, thank you very much indeed. Liberation Day, apparently. Alexander Jekov, G10 FX Strategy, Europe head at BNP Paribas Markets 360, joins us this morning. Good morning.
Good morning.
How are we set up into next week? How do you think the FX trade is looking like going into the big tariff day next week?
Good morning, and thanks for having me on again. We think the way the FX market is set up into next week is one where tariff uncertainty is high, so volatility for the event risk next week is high, but the market isn't long dollars, or at least not significantly long, either in options or in spot when we look at our metrics. So I think what the market is saying, or the way we're reading it, is perhaps the market doesn't think tariffs are here to stay, doesn't think tariffs are permanent, therefore tariffs are growth negative via higher trade uncertainty, but the market doesn't perceive them to be inflationary. That's the bit that we disagree with. We think tariffs are here to stay to some extent, and therefore inflationary. With that, the Fed will have a hard time cutting this year. What we're saying on Eurodollar is that European fiscal stimulus is a more important driver than tariffs, and so Eurodollar can still appreciate in an environment where the Fed keep rates on hold.
I want to come back to the euro in just a moment. Inflationary for how long? Because even if they stay, isn't this just a one-time shock? That's the kind of Susan Collins point.
Yeah, so the Fed is obviously fighting this battle now between growth and inflation. We think ultimately they'll prioritize inflation because of tariffs. Like I said, the bit that the market isn't pricing yet. We think inflation will then peak around Q4, and that'll enable the Fed to start cutting next year. So no cuts this year, but potentially, or our view is 5 cuts from the Fed next year, which means the dollar will stay well supported versus most currencies, with the exception of euro for this year, but see the bulk of weakness in 2026.
I'm looking at your forecast here for Eurodollar, 112 this year, but 120 next year. despite the tariff impact, and a lot of that's baked into your call on the fiscal, could the tariff impact erode any sort of fiscal impulse, not only from Germany, but others as well?
I think that's the key question, Kriti, for us. Eurodollar is a story of Eurozone fiscal. We think it's a real game changer for FX. Why? Because it means structurally higher growth. It means structurally higher bond yields rather than this 2 to 3% range. In the coming years, we think we'll find ourselves in a 3 to 4% range, and that's something that benefits the euro. The real kicker for FX comes from flows. We think higher bond supply means European investors are increasingly going to be crowded into domestic fixed income markets, and potentially there'll be a marginally slower accumulation of US equities as well going forward. And that really changes the FX picture, and that's why we're looking for 120 by the end of next year.
Well, if your case is rooted in the fiscal impulse, what makes you so sure that the fiscal multiplier is going to be that fast and that effective to get to the euro by 120 next year?
I think the fiscal multiplier is of course something that's only going to become clearer over time as we get more information on how and where the money is going to be spent and how fast. But I think for now, given the information that markets have, it's clearly a game changer for FX. To give you an example for the ECB, although we look for cuts this year, for next year in H2, we think hikes are actually on the table. So next year you could get proper monetary policy divergence where the Fed are cutting and potentially cutting relatively aggressively, but the ECB are hiking.
I wonder what the European tourism story, which is super important, will look like at 120. Like, a lot of American tourists have come with a very, very cheap euro, and the European economy's benefited from that. That could change if you get to 120. If Eurodollar is going to 120, where's sterling going? Where's cable going?
We think sterling or cable is largely going to be flat this year. So in other words, even though we have a bullish Eurodollar profile, cable is unlikely to benefit going forward. Sterling has benefited so far from the bullish euro story and high yields. We think a number of vulnerabilities make it difficult for the sterling rally to continue. The first is fiscal fragilities. We saw the headroom reinstalled this week. Fiscal headroom.
Apparently half of it's already gone, but yeah, okay.
And I think that's kind of the point. It's that if yields rise again in the UK, that headroom could very quickly get eroded. And sterling is likely to be most sensitive to that, given the way the market's set up. The market's long sterling on our metrics, and so if fiscal fragility start to come back to the fore as a theme for the market, then euro sterling can head higher.
Well, the reason people are perhaps so bullish on sterling, or at least positioned that way at the moment, 129 on cable, as you can see on our screen, is because there's a thought that the UK is more insulated from the international tariff war that exists. To what extent is that true?
So, looking at auto tariffs, for example, they were announced recently. It doesn't look like the UK is fully insulated, but it's true that they seem to have been largely exempt when compared to other countries. I think the key point is that, yes, it's a bullish factor for sterling, but the more important drivers are potential fiscal fragility and the BOE, where if the data is better, there is a chance that they skip May, not necessarily what we think, but the point is our terminal rate for the BOE is 350 basis points, whereas the market has it at 4%. So we think rates can fall by more than the market, even if the UK is exempt from tariffs, or fewer tariffs are put on the UK than other countries, sterling's likely to be weak.
All right, Alex Jekov, G10 FX Strategy Europe head over at BNP Paribas Markets 360. He's going to have a fun couple of days in the next week or so. It's a fascinating guy that he's talking then about the fact that the UK is insulated to some extent, but maybe that's already priced in.
Yeah, and I think the bigger story is how limited Rachel Reeves' room for manoeuvre is. Are we going to head to another crisis before we get to the autumn statement where she has the opportunity maybe to raise taxes again? She doesn't have much room to play with. What's coming up?
Well, we're going to switch focus a little bit. Although it all is all kind of emanating from the center that is Washington at the moment, Bloomberg has learned that the U.S. is pushing to control all major future infrastructure and mineral investments in Ukraine. What does that mean? We're going to break down the impact and the potential deal in the works next. Stick with us. This is Bloomberg. "30 minutes from the start of the opening trade, we're already setting ourselves up, perhaps a poor start, a weak start to the European Open. A little bit of risk sentiment that you were seeing not just in the equity market, but across the bond market and the FX market as well, pointing lower, underperformance in France, underperformance in Germany as well. We should also get a quick check on this bond market as well. Over in the States, you are also seeing a bid into the U.S. bond market, 432 on the U.S. 10-year, and a similar dynamic across Europe as well, 273 on the German 10-year, and a similar tone across France and Italy.
It feels at the moment like we live in a world of extraordinary news stories. So every day there's another kind of superlative extreme, whatever it is.
Yeah.
The story on Ukraine this morning feels like it's taken it to a whole new level, it's just absolutely extraordinary. So Bloomberg has learned that the US is pushing to control all major infrastructure and mineral investments in Ukraine. So this is a draft document that Bloomberg has seen, and apparently it's looking to grant the US first claim on profits transferred into a special reconstruction investment fund, and requires Kyiv basically to pay for all US military and economic support since the start of the war. Joining us now, we're joined by Bloomberg's Tony Halpin, who leads our Russia economy and government coverage. Tony, this is extraordinary. Absolutely. I had to read it twice this morning just to get my head around what is being talked about here. Can you just give me the details as to what we're talking about and how far it goes?
Yes, I mean, as you've noted, the US is looking for a right of first offer in a joint reconstruction fund with Ukraine that would allow it basically to take charge of projects covering things like roads, railways, ports, mines, and critical infrastructure, critical minerals, oil and gas. So essentially, enormous areas of Ukraine's economy would have come under the purview of this fund, and that the US would have the right of first decision to decide whether it's going to invest in these particular areas and whether these projects then will be included in the fund, and whether the profits then from those projects get deposited in the fund for the US to have first claim upon. So it's an extraordinary extension of US influence in a European state's economy.
Well, Tony, let's talk about how the European officials are perhaps thinking about the same thing. They have, of course, rejected easing sanctions on Russia. That was part of the readout from yesterday's Coalition of the Willing summit. They're also talking about some sort of reassurance force, a peacekeeping force in Ukraine, which, of course, Putin has said is a non-starter when it comes to negotiations. How does that position Europe when it comes to the negotiations with President Trump?
Yes, potentially there are odds now with President Trump. As you noted, the Kremlin, in the last negotiations over a Black Sea ceasefire, made clear that its participation was conditional on sanctions relief, in particular for some banks being reconnected to the SWIFT international payment system. That's a European system. The Europeans yesterday made very clear that they think this is not the time to be easing sanctions upon Russia. And yet, if the US wants to make some advances in its negotiations for a ceasefire, the Kremlin is basically demanding that that happens. So it puts the Europeans in a difficult position in relation to the US. And also, as you note, the Russia is very hostile to the idea of European troops being positioned in Ukraine as part of any ceasefire agreement. The Europeans yesterday didn't really make much advance in agreeing on what they would do with this reassurance force. So those are two areas really that we still have a lot of questions about.
Well, we look forward to seeing how this all plays out. As Guy says, truly an extraordinary story, extraordinary developments on both sides of the Atlantic. Bloomberg's Tony Halpin, we thank you so much for helping us break it down. Let's take the same story and look at it from an economic lens if we can. Joining us now, I'm pleased to say, is Modupe Adegbembo, an economist over at Jefferies, joining us around the table. Pleasure to have you on the program here. We're talking a lot about this kind of massive fiscal impulse as well, not only on the infrastructure front, but certainly on the defense front as well. How quickly can that be put into motion from your point of view?
I think from my perspective, actually, we're probably going to see it implemented quite in a delayed fashion. Of course, in Germany, we've seen a lot being done in quite a short space of time. So we've seen the Bundestag kind of pass the reforms to the debt brake. But when you look at it from an EU perspective, there's a lot to do. Joint EU issuance, of course, we think is going to rise, and it's going to do that because a lot of EU countries just don't have the fiscal space to increase their borrowing. But that also means that there's going to be a lot of discussions about what form this will take, how the kind of rules around this increase in borrowing will be. And therefore, I think there is going to be quite a long kind of lag time. I don't think markets are necessarily considering that at the moment. I think they're seeing the kind of conversation and where it's moving, but not that it's going to take a lot of time to mobilize those funds and actually impact the economy.
So mobilising the funds, impacting the economy, that's the good side. Is there a downside here, though? And we talked earlier about what's happening with Spain and this idea that the Spanish economy has done really well. If we see higher yields coming, we don't get the benefit, but we get the higher yields.
Yeah.
Are we going to start to see big hits around Europe? It feels like we maybe get the good bit later and the bad bit earlier. I don't know.
Like the inflationary impulse earlier. Is that
well, just the higher bond yields, just the fact that that's going to slow down European growth potentially.
Well, how do you view that? Is that a deterrent?
I think that is a potential. I mean, when you look at the kind of increase in bond yields we've seen, it is quite significant, especially for those kind of periphery countries. But I do think that at least for the inflationary impact, what we're more likely to see at the moment, and what I'm more worried about, is probably on the Trump tariff sides, because I think lower growth is more likely to kind of hit inflation over the shorter term than that kind of potential hit from higher bond yields. But I do think it's a risk. And I think we're in this situation where we could be in a bit of a stagflationary environment. I think for the EU, it feels further away, but it still is a conversation that I think needs to be had and needs to be considered.
So what does the ECB do in this scenario?
I think for the ECB, the main thing that they will be considering is of course ensuring price stability, but I think there's also going to be a focus on ensuring spreads don't widen too much. At the moment, that's not an issue. We've seen spreads tighten, actually, even though yields have risen. But I think, as you mentioned, when you look at the outright level of yields in periphery countries, we could be getting to a situation where the ECB needs to make sure that we're kind of in a situation where spreads are very well kind of orderly and maintained. But
I'm curious, though, if we talk about the positive impact there, as you mentioned, from this fiscal impulse, but there is that tariff threat as well that's looming over our head. Is the fiscal impulse from Germany and elsewhere in Europe enough to offset the impact of tariffs from a growth perspective?
I think when you look at it from a growth perspective on aggregate, ultimately the way that we're seeing it now is probably the both offset each other. So you have this increase in spending, which could boost Eurozone growth by 0.2 to 0.3% on aggregate. Then you also have this potential hit from tariffs, which we think could reduce growth by around 0.2 to 0.3%. So essentially, you're kind of in a similar position. I think, of course, it kind of depends, particularly on the tariff side, what form the tariffs take, retaliation. A lot of that is still quite uncertain. But I do think we're in a situation where actually there isn't a significant impact from the fiscal expansion.
So if you have a net-net kind of dynamic that you're talking about, does that then shift the focus perhaps away from fiscal, or of the fiscal impulse, and perhaps away from the tariff impulse, as you point out, but then perhaps focus more on the deficits? Are we circling back to where we were a year ago?
I think potentially, because when we get to that situation, I think markets haven't necessarily been as focused on the deficit situation over the last couple of months. I think markets have also been quite comfortable with seeing countries talk about increasing borrowing as a result of the risks that they're facing. But I do think you have to question, when yields are rising, they're getting higher, but the actual levels of deficit that we see in the Eurozone isn't falling. There is a question there. And we're seeing it more maybe in the UK, because the UK kind of regime is slightly different, but I do think it's an important kind of story.
What's your outlook for the UK? Rachel Reeves clearly has little room for manoeuvre, and it feels like it's vanishing kind of almost on a daily basis. We've only just had the spring statement. How do you track this through for me? What happens between now and the autumn?
I think it's really challenging, because when we've seen the kind of headroom be rebuilt, I think my main takeaway is that headroom was eroded by about £15 billion in 5 months. The same can happen. It looks quite likely that it will happen this time around. I think the challenge, or the bigger challenge this time around, is that it looks like Rachel Reeves has really exhausted a lot of the levers on reducing welfare spending and reducing kind of departmental spending, and therefore it looks like taxes are the only thing that... Or
productivity, which would be nice, but taxes probably more realistically.
Would be very nice, but I think it's something that's really out of her control. And it would be amazing, and I think that's what they're hoping for, is that growth will be stronger, and so that will be a lift to the public finances. But I think it's a lot more likely that we'll have to see taxes increase in autumn to deal with the shortfall that is likely to come.
Do we see a commensurate... What do you see in terms of the Bank of England doing? Where we were talking about this just a moment ago with BNP Paribas. How low do yields need to go in the UK? How low can they go?
I think the main challenge is, so just to give a kind of context, I think we expect the Bank of England to cut 3 more times this year. Markets are still kind of in the 2 more cuts this year camp, so we do expect the Bank of England to go further. But I think the challenge is that gilt markets just don't seem to believe that the BOE will be able to deliver that. I think they're really, really worried about this stagflation outlook. And I think that's kind of out of the Bank of England's hand. I think it's more in terms of the data that we see over the next 2-3 months. If we start to see inflation, not come down, but remain around current levels. And I think particularly in April, that's one of the things that I'm really looking to. Inflation is expected to rise to around 3.5% in April. And I think if we start to see something that's slightly weaker than 3.5%, that might be quite important because people will feel like, OK, the trajectory might be slightly more benign than we were expecting. But I think a lot of it is in the hands of the data rather than the policymakers. Yeah. They're trying, but there's limited to what they could do.
A for effort. Little participation trophy there. Modupe Adegbembo, economist over at Jefferies, joining us around the program, covering a little bit of everything from the tariffs to the monetary policy in Europe and now, of course, the UK.
Coming up, we need to talk about some of the stock stories we are watching this Friday morning. Ubisoft is carving out, we understand, a unit which will include some of its top games like Assassin's Creed and Far Cry. It's going to go into a subsidiary. The EV, the enterprise value of that business, could be over $4 billion. Plenty of other stocks we're going to be watching as well into the open. We'll bring you all of that very, very shortly. We're 18 minutes away from the start of trading this Friday morning. This is Bloomberg.
We are just about 15 minutes away from the opening trade. Risk sentiment is souring across the board when you look at the equities picture. This is pretty classic in terms of the playbook guide when you're looking at tariff risk going into the weekend and, of course, into next week. Futures lower across the board.
Absolutely. French CPI data dropping onto the Bloomberg terminal as we speak. The EU harmonised month-on-month number comes through at 0.2. That is up from the 0.1 last time round, but not as high as anticipated. So a slightly more benign inflation reading there. The year-on-year number, therefore, goes to 0.9, which is exactly what we saw last time around. So there was an expectation maybe that we would see actually the numbers starting to tick a little bit higher. That has not happened here, which I think is really interesting. In terms of the kind of straight non-harmonised numbers, they're also coming in a little lower than anticipated. So maybe some good news for the ECB.
Good news for the policymakers as falling below that 2% benchmark. But you are looking at falling energy prices, certainly a part of that. If you were talking about tariff risk, does that actually help the case for falling energy prices? Services inflation, on the other hand, still picking up pace over the month. So perhaps that is the canary in the coal mine that everyone needs to keep an eye on. We'll switch focus here from what's happening right here in Europe to what's happening in China. China's president has been meeting with global business leaders in Beijing in an effort to boost international investment. Xi Jinping sat down with representatives from firms including FedEx, Standard Chartered, Sanofi, and AstraZeneca.
In recent years, foreign investors in China have also been affected by geopolitical factors. We have always believed that maintaining the stability, health, and sustainable development of China-US relations is in the fundamental interests of the peoples of both countries.
Our China economy and government editor Alan Wong joins me now from Hong Kong. Alan, walk us through President Xi's message.
So China's President Xi Jinping met with these 40-plus foreign global executives at the Great Hall of the People in Beijing. And he promised the usual open market access, a better business environment for investors, and he said that China welcomes investment. But there's a clear subtext here is that Xi Jinping is trying to project openness and stability just a day after U.S. President Donald Trump threatened potentially more tariffs on the EU and Canada, as well as announcing 25% tariffs on car imports. So China is playing its stability card here to try to court these executives for more investment. This is quite interesting because of the timing also for the domestic economy, which is struggling to increase its domestic demand, a top priority for the economy this year. And that is important for all those executives who came to China this week for lots of forums, because a stronger consumption pattern in China will help them sell products to China's massive middle class. And the other thing to watch out for is that when Trump's tariffs, reciprocal tariffs come in next month, as well as potentially further trade actions enter effect, how that affects China's economy will also be something that those executives will pay attention to, because ultimately President Xi Jinping could say a lot about opening market access, but what matters is how much more profit they can earn in the world's second largest economy.
Thanks for the update. Greatly appreciated, Alan. Thank you very much indeed. Bloomberg China economy and government editor Alan Wong joining us on the meeting a little bit earlier on today. I just want to update everybody on what has been happening in Asia and Asian markets. There's been a big earthquake in Myanmar. I think 7.7 is the magnitude of it, according to the US Geological Survey. I think it's been relatively shallow, so it's spread out a great deal. It's spread out relatively quickly, and obviously the effect of it shallow is significantly greater as well. But it looks like you've seen it rippling out and affecting Thailand, Vietnam. The Thai bourse, I think, is closed early. It is currently closed. I think it normally closes in a couple of hours from now, so it has closed early as a result of that. So people are being very cautious in terms of the effect of this. But 7.7 is significant.
Absolutely. Shaking buildings, triggering evacuations, and potentially affecting, as you said, Thailand and Vietnam. We will bring you more updates as we get them on the program. Let's come back to the markets, though, and bring in Paul Dobson, Bloomberg's executive editor for Asia markets. Paul, let's bring it back to perhaps the top story that is shaking the markets about 10 minutes away from the European Open, and that is this tariff story, this countdown to Donald Trump's Liberation Day next week. For you, what is the canary in the coal mine here? What is the trade that people are putting on or taking off?
Yeah, morning, Kriti. So it's our reporters have obviously been speaking to macro fund managers all around the world to try to get a consensus view on that. And I think that two things emerge from that are pretty clear. One, that everybody has been scaling back risk in recent sessions. And of course, you can see that in declines in the equity market, widening credit spreads, the rally in gold, those kinds of things. But also, it seems that quite a few of them are still of the mind that this is going to be an opportunity to buy a dip. That people are looking to come out of it with, a surprise kind of a rally or an opportunity, or maybe it won't be as bad as you thought. So I guess if you're looking at where the balance of risks is, that could mean that if Trump is as aggressive as, he's been promising in a lot of the rhetoric, bar the last few days, that could still trigger quite a negative market reaction because perhaps people aren't quite prepared for that at this moment in time.
Paul, what's the bigger event next week? Is it the tariff story or is it payrolls?
I think the tariff story on a global scale is a thing that everybody is ready for and paying attention to. Yes, okay, the US economy is kind of important and what the Fed does is going to matter. But even then, I think that the market is focused really on what that long-term tariff risk is, even for things like inflation and the labor market that the Fed will need to pay attention to. If you look at, say, the US yield curve, we've got this steepening of the 5s, 30s, which shows that people are pricing in higher inflation for longer. That's spread at the widest in several years now. You've got break-evens widening back out. And again, like I said, the gold trade, which could also be seen as an inflation protection measure. So I think that people are worried about the stickiness of inflation, and people are worried about, if the labor market starts to deteriorate as well, what that looks like in terms of the sort of magnification effect. But what people are really focused on is what's the damage from the tariffs going to be to the US economy, and can Trump put it off, and will it be okay?
Well, Paul, we've seen a lot of habit, I have to say. I'm very sorry. But, Paul, we have to talk a little bit about perhaps what is priced into this market. So much of an expectation of those set tariff story. Is that going to show up, for example, in the PCE data later today?
So I think that people are looking for a little change in the PCE, which is, you could read it as, okay, so it's been moderating very slowly, or it's still sticky and holding up. And I think that what the Fed speakers that we've been hearing from recently are fixated on is the idea that it's not coming down as fast as they would really like, and therefore they're going to be keeping interest rates on hold for longer. We heard that overnight from the likes of Collins, Barkin, I beg your pardon. And so that, all things being equal, would see them not reverting to cuts anytime particularly soon. And that would be, kind of not offering any support for the economy as those tariff effects start to really hit home.
Well, we will certainly see how that all unfolds and plays out in the next couple of minutes, as well as into the weekend. Paul Dobson, Bloomberg executive editor for Asia markets, joining us this morning. Now let's get our stocks to watch with Joe Easton from our equities team. Joe.
Morning, Kriti. So we're watching sportswear stocks today in Europe, given the drop we saw in Lululemon shares in the post-market trading yesterday, as the company warned on a weaker US consumer. And the US, of course, a big market for both Puma and Adidas. Neither of those stocks have been on a great run recently. Puma has been the underperformer given its soft updates, but both of those potentially going to be a little bit softer today. Then in terms of video games, Ubisoft is soaring on the Tradegate exchange this morning, and the US listed shares did the same thing yesterday, rising around 14% as the company carves out a new unit for some of its key games, including Assassin's Creed, and gets a big investment from Tencent for that unit. So that looks like a positive one today. Then over in banking, Deutsche Bank has got a new CFO coming over from Morgan Stanley. He's currently the deputy CFO of that firm, but the current guy stepping down is a bit of a shock, according to analysts at JP Morgan, who say that the new person coming in is going to have their work cut out to continue the good work that has lifted the share price on that one. So that one is actually a little bit weaker on the Tradegate exchange today. Then in terms of rating changes, Ferrari has 2 upgrades, both at Kepler Chevreux and also Barclays, after they reaffirmed their guidance yesterday following worries about tariffs. Michelin is a buy at HSBC, and we've also got a new buy rating for Adecco in the recruitment space. All of those could be positive in European trade this morning.
Joe Easton from our equities team giving us those stocks to watch. As Joe was speaking, I should mention we have been seeing a bond market that is continuing to see a bid. Yields are compressing across the continent.
French data coming through, inflation coming through weaker than anticipated, massively below where the ECB target is 2%. We're below 1%. So this is a big story in terms of maybe giving the ECB a little bit more room for manoeuvre. Anyway, as we've just been indicating, the market's about to open. We're 5 minutes away. Futures currently pointing a little bit negative, as you can see. We'll track you through the open next. This is Bloomberg. Friday morning, couple of minutes to go until the start of European equity trading. Let's talk about the session yesterday, give you an idea of kind of where we're coming into Friday. European equities actually rallied into the close yesterday. Back half of the session looked fairly positive, but the US market drifted after we had closed. Doesn't really give us a clear sense of direction. At the margin, maybe a little bit negative. People starting to maybe retreat to the sidelines by the back end of Thursday's session. I think that will be the story for Friday's session. At the moment, this is what futures are pointing us to this Friday morning. Let's show you what Europe is set up to look like. Euro Stoxx 50 down by around 0.6%. London looks like it could be actually an area of relative calm. DAX down around 0.5% as well. Carey's going to talk about the bond market as well, which is something you want to be paying attention to this morning after the French CPI data. But the setup into equities this morning, Carey, actually looks fairly negative. But I wonder what volume will look like. I wonder what breadth will look like. I wonder what all the other metrics will tell us about a market that maybe is just waiting to see what happens next week.
Absolutely. So many questions to answer. Let me maybe attempt at some of them. We'll start with the bond market, where you are seeing a drop about 6 basis points in Germany. But given that we are on the countdown to the European equity open, let's talk about some of the stocks that are going to be moving. Ubisoft very much seeing some Tradegate pricing here. Looks like they are talking about potentially carving out a unit that would hold their top gains. The key franchises, something that Tencent would also get a 25% stake in. You're already seeing a 14% rise on Tradegate pricing. We'll see how that shakes out at the open. Deutsche Bank also announcing a successor to their CFO role, so perhaps something else there for the markets to digest. And I'll also put the Ferrari upgrade over at Barclays on your radar as well. Joe Easton was just mentioning it. We're talking about a unique tariff resilience. Guy, let's see if the markets interpret it the same way.
Yeah, prices are going to go up circa 10% in the United States as a result of tariffs. Not the complete tariff hit. Right, let's talk about the Friday open trade. Let's show you what is happening, give you some numbers, give you a sense of what is going on. We anticipate that London will be down, but not by that much, certainly relative to the rest of its European peers. The IBEX is already open. We're down by 0.4% there. Keep an eye on what is happening with euro dollar today. I think the bond market and the foreign exchange story could be interesting as well. 600's down by around 0.2%. We'll see whether that drops a little bit more once we start to get the CAC opening up this morning, and in particular what we see coming through from the DAX. But at the moment it's a negative setup, Carey, as we start the day here in Europe Friday, but we're really anticipating what the picture is going to look like next week. I think a lot of people are going to be looking at a lot of risk next week and wondering whether or not they actually want to sit on their hands today.
Absolutely. And of course, you see risk sentiment across the board. When we're talking about breadth in this market, it is certainly to the downside, Guy, down about 366 stocks and counting. So you can see more red than green. But a little bit of that defensiveness showing up in this market. Utilities, telecom, health, and even the property sector seeing a little bit of outperformance, but broad declines across the board when you see some of these other moves as well, specifically in the technology space and the banking space as well. Now, the banking story might actually be a little bit of that read-through from the inflation data we just got out of France. We're also just seeing it out of Spain as well. I'll give you the numbers now. The Spanish preliminary March harmonized CPI rising 2.2% year over year. The estimate was 2.5%. So again, seeing a drop similar to what we saw in the French CPI below what the estimate actually was. And that's going to be something that is reflected in the bond market as well, accelerating perhaps the bid you are seeing into the global bond market, not just on this side of the Atlantic. Let's talk about some of the individual equity movers as well. We talked about Ferrari ahead of the open. It is your biggest index contributor to the upside. This is coming, of course, off of that Barclays upgrade, saying there's a little bit of tariff resilience baked in there. So you're seeing a move about 2.5% and counting to the upside. That's going to be one that we've got our eye on. Novo Nordisk, I believe, is ex-dividend today as well. Those shares higher by about 1.6%. They've got a slew of technology names on the back foot.
Ubisoft is up, though. 8%. It gapped higher first thing this morning. It's coming off that initial high, but that stock is certainly having a very good morning on this carve-out story that we brought you a little bit earlier on. Tom McKenzie's going to be joining us very shortly, actually, to talk us through that one. So it is having a very good day on the back of that. We saw that pre-market as well. We have got some Spanish data as well, which I think is worth mentioning. The numbers come in soft again. But they're significantly north of the French numbers. It is interesting that we are seeing inflation maybe tracking a little bit softer than maybe the market has been looking for. But let's talk a little bit about the broader market and how this all folds in, because euro dollar, it was interesting to hear that call a little bit earlier on from Paribas at 120 potentially next year.
Yeah. Well, we're dealing with a very interesting environment, which is very normal for a Friday, which is you sell off into the weekend, you sell off against the tariff risk. Perhaps you're seeing a little bit of buying on Monday. So you're seeing that in the equity market. You mentioned the Spanish CPI. We talked about France earlier as well. When you look at the bond market, you do see a little bit of movement, and that's putting it lightly, an almost 5-6 basis point move across the continent. Compare that to what you're seeing in the States, and it's not as dire of a sell-off, but certainly that risk-off mentality is turning into a cross-asset story, and those weaker than expected inflation figures not necessarily helping.
No, I think that's the catalyst. Well, it's certainly helping the bond market this morning. That's the bid where we're seeing. But I also wonder whether there's a safe haven bid in amongst all this as well, in terms of people looking for somewhere maybe to hide out a little bit. Joining us to talk about that is Valerie Genin, Head of Investments at Barclays Private Bank, Monaco. Good morning.
Good morning.
Nice to see you.
Nice to see you too.
Should I find somewhere to hide out at the moment? We've got an awful lot of risk coming across the table in terms of the tariff story, what's happening with the growth narrative around all of that. How do you see the market at the moment? Should I be defensive? Should I be looking to buy dips? How are you setting us up?
Well, in terms of hiding places, you've mentioned this morning that the gold is rising again, and this has been a long-standing trend now. So this is one place to hide, of course. But I think the best place to hide is just to create a well-built, well-diversified investment portfolio. And you want to diversify in terms of across asset classes, of course. So you want to go and tap into those private debt, private equity, hedge funds, asset classes, but also within asset classes. You know, for example, equity. So you want to diversify away from the US and build up a little bit the exposure to the rest of the world. And in terms of sector, talking about US equity, you want still, we still like very much the tech, the growth stocks, the quality growth stock in the US. But you want as well to go into the less cyclicals and defensive stocks. You want, some healthcare and utilities, for instance. They've done really well year to date. So you want to be well positioned.
Right. How different is my portfolio now, how it should look versus the last few years? The last few years, all I've needed to do was buy US tech to do well and outperform. How different does it look now? And how defensive do I need to be?
Yeah. So, yes, the US tech play has worked out really well for the last few years. I think for the time to come, for the next few months and years, you need to diversify further. And we've seen the momentum in European stocks. We think that this is, represents a fundamental shift. This will be here to last for the next few years, even though it's going to be very gradual, but it is a very positive shift for European equities. So you need to diversify better.
Well, you like to make the point that if you diversified in this market, you'd underperform the broader market,
if you were out of tech over the last few years, you have underperformed. So a diversified portfolio hasn't worked.
Absolutely. So let me put that to you, though. Now, we talk about diversifying, but it's the trick here as we're dealing with the tariff volatility, the geopolitical volatility, to actually look inwards, to find companies and countries that actually don't have international exposure, which is the exact opposite of the traditional diversification method.
Diversification doesn't always work. However, you can sleep at night, right? That's the value of it. It adds a lot of brownie points to it.
Not on mid-shift.
Exactly. And look at it in terms of equities and fixed income, for instance. Right now in the US, the fixed income market remains very strong and resilient, whereas US equities are being hammered. So, this is the value. This is exactly what you want. This is the value of being diversified across asset classes. And then you add to it FX and you add to it, alternative asset classes.
What is the driving factor when it comes to investment right now? And I say that almost superficially in that we keep talking about tariffs, but I'm curious if the real canary in the coal mine or red flags for investors is actually the monetary policy more than it is the fiscal.
I think there are two driving factors right now. First of all, the weaker consumer prints that we've seen from the US. I think this is spooking a little bit investors. The soft data that we got so far are a little bit weaker than expected, even though the hard data remains very strong and very resilient. And therefore, we are not at Barclays worried about a US recession as a base case. And of course, all the noise about tariffs is creating a lot of fears in the market, not just the level of the tariffs, but the way they are implemented as well. So in terms of level of the tariffs, it seems like investors are just digesting now that tariffs have lose-lose implications for all parties. When Trump got elected, there was this massive momentum and bullish spin on U.S. equities, even though we knew that it would put tariffs on, right? And now we realize that everyone will lose out of that. We just recently halved our U.S. GDP growth forecast for this year from 1.5% to 0.7%, so they will lose as well.
So there's a lot of uncertainty.
Yes, that's for sure.
Yeah. So why don't I just sit in cash? Isn't that the logical place to be right now until the uncertainty clears? You're still getting a decent yield on cash. Should cash balances be higher? What are you advising in terms of how cash fits back in? You look at money market funds, every month I'm astounded by how much money continues to pour into them.
Yeah, and you've got $6 trillion sitting in money market funds still today. Cash was a very attractive alternative for the last 2 years, pretty much. It still is as of today. However, we think that rates will be cut significantly over the next few months. So if you stay in cash, you will miss out the opportunity to lock yields and crystallize the higher yields that you can see right now.
But do you sleep at night?
So in terms of cuts, we see 2 cuts from the Fed this year and 2 more next year. We think the ECB will cut 4 times this year to get to 1.5%. And 4 from the Bank of England as well. So, if you stay in cash, you lose out. This is a cost of opportunity.
So what do you do in terms of playing some of these, though? I can hear you on the diversification.
Yeah.
The last time we were in a trade war like this under the first Trump administration, people viewed diversification as having exposure to commodities or having exposure to currencies you wouldn't traditionally have exposure to as well. Does your definition of diversification include, in some ways, be kind of a macro tourist to other assets, including perhaps private investments or including perhaps traditional commodity markets that aren't maybe accessible or emerging markets that aren't traditionally accessible or as liquid as previously expected?
Yeah, alternative asset classes make up right now for, a substantial portion of the investment portfolios of institutional investors, sophisticated professional investors, up to, 25-30% in some cases. So this is significant. And in terms of liquidity, in terms of addressing that, we've seen some opportunities lately come out as semi-liquid. Therefore, you're not stuck and you don't have to buy and hold for 10 years. You have today other opportunities whereby you can be a little bit more flexible around that.
Can I just ask you about the relationship between European equities and US equities? Can they go in different directions? And if so, for how long? The US market has been the gorilla in the room for a long time and everything has orbited around it and it has set the pace. Is that still the case? Can I invest in Europe, see the US market go down and not expect to be hit as well? I appreciate there's a kind of relative trade that can be on, but so far the evidence this year is that can be the case. Can it carry on being the case?
So it can be the case, yes, because we're seeing that right now. In fact, the divergence is quite substantial and has lasted now. It's a few months that it's been lasting. However, probably that gap will narrow at some point. There is this old saying that when the US sneezes, Europe catches a cold, and I think that stays true. So if we were to see potentially a US recession or stagflation in the US, I doubt that European equities could remain strong and resilient to that.
Been great to see you this morning.
Thank you.
Thanks for stopping by to see us. Valerie Genin, the head of investments at Barclays Private Bank, Monaco. Thank you very much indeed. Let's take a look at the Core 6 this morning and look at what is happening here. We've already mentioned a double upgrade for Ferrari. It is having a reasonably good day. Obviously, the auto sector was firmly under pressure yesterday, but Ferrari bounces back today. There's some weakness in the tech space, some weakness in the kind of peripheral AI story. ASML, Schneider, both seeing some weakness as well this morning. I think Novo's gone ex-dividend today. It's tracking higher, which is certainly nothing to sneeze about. LVMH, though, is down by, as you can see, circa 0.5%. Let's check in on some of the individual stock stories that aren't on that board. Joe Easton's got the details.
So we have got some movement, Guy, in the sportswear stocks at the moment here in Europe. So Adidas coming off a little bit, down around 0.8%. Puma coming down 1.2%. This, of course, a read across from Lululemon last night, which gave a really downbeat forecast on the US consumer, and also does seem to be some data on the mall visits, according to analysts, saying that that is a negative for sportswear and apparel retail in general, and therefore seeing that read across coming through as the yoga wear maker hits that sector today. Then in terms of the one for the gamers, Ubisoft is a big mover over in Paris, spinning out or carving out that business that includes Assassin's Creed and all the big punchy names in terms of their titles, and getting a big investment, a few $1 billion coming in from Tencent as well. So that is a positive one. In the French markets, we're up 8% on Ubisoft. Not quite as big as we saw in the US yesterday, but nonetheless a decent move for that one. Then staying in France, a sector not doing too well is the meal vouchers. This has been a big thing for the French market traders, and there is a report out in Les Echos in France overnight saying that the government potentially going to be reining in the fees that these companies can charge. And we were seeing Edenred, that was the worst performer at the open of trading here in Europe today. Pluxee as well, that one's slipping, both of those dropping on a report, as I say, in Les Echos around meal vouchers and the potential regulation on those. Then Deutsche Bank, a CFO standing down, and he might be, well, a little bit pleased, I guess, to see the stock lower on his departure. That stock falling 3%, and analysts saying that he's done a really good job, and it is a surprise that he's stepping down. They've got a new guy coming in from Morgan Stanley, the deputy CFO, moving over from the US to Deutsche Bank. But it is a shock for the investors that the CFO is standing down, and therefore the stock down 3%. Talk about shocks. WH Smith no longer going to be on the high street. I actually had a job on the till there when I was about 15 years old, and now here I am reporting that the company will no longer exist on the high street, as its main business, the retail on the high street arm, sold for only around 75 million quid. We've got around 500 stores, so that is not a very big amount of money, but the stock dropping around 1.5% at the moment. WH Smith will only be available in your airports and trade stations going forward. Then finally, touching back in on Ferrari, as Guy mentioned earlier, 2 upgrades for this stock. One of them is at Barclays. They are overweight on the stock, of course, after a big drop, but Barclays saying that this is a very resilient company to the tariff issues, and that's exactly what Kepler-Chevreux also said in the same kind of report this morning. So they both upgrade the stock, Kepler and Barclays. Ferrari rising 3% in Italian trading this morning.
Joe Easton from our equities team, we thank you so much walking us through some of the early movers. Coming up on the program, Germany's largest bank unveils a series of leadership changes with CFO James von Moltke set to be replaced. We're going to dive into the details next. This is Bloomberg. Welcome back to the opening trade. We're 18 minutes into today's session. Some of the risk sentiment that was off 18 minutes ago has kind of paired some of its losses, at least when you're looking at the broader stock 600. But the underperformance remains very much in the auto sector, and it feels like that's where a lot of the pain is when it comes to the DAX, even the CAC run as well. The FTSE 100 coming back up, perhaps escaping some of the gloom and doom.
Yeah, I I don't feel like the UK is escaping much gloom and doom at the moment, but we'll park that conversation for another day. Deutsche Bank says Morgan Stanley's Raja Akram will replace Chief Financial Officer James von Moltke as part of a raft of leadership changes at Germany's largest bank. Akram, Morgan Stanley's deputy CFO, will join Deutsche in October. Arno Schützer joins us now to discuss. Arno, why? Why is James leaving? Why are we seeing these changes coming through?
Right. So James has been in this role for 8 years. It'll be 9 years next year, and apparently he's up to doing something new. He decided to leave the bank, and because they're bringing in somebody new, Raja Akram from Morgan Stanley, from the outside, they've decided to do this sort of long transition period of Akram joining the bank in fall and then taking over sometime next year, probably. Well, I don't know, maybe around this time of the year, to be seen.
Well, Arno, talk to us a little bit about the environment that the CFO is going to be, or the new CFO is going to be inheriting here, especially in the context of the playbook that European banks have been using around buybacks. It's almost this massive momentum that you've seen. Deutsche Bank, for example, this morning announcing they're starting up to 750 million euros of a buyback as early as April 1st. Put that into context for us for Deutsche Bank.
Yeah. So, James von Moltke and Chief Executive Christian Sewing are credited of having turned the ship around. When they started, so Moltke actually started sort of a year before Christian Sewing became CEO. And at the time, Deutsche Bank was in a terrible state, and the two of them have actually turned the bank around. They were doing quite well of late. Much like most of the European banks, to be honest. And yes, they have committed to returning a lot of capital to shareholders. And generally speaking, the management team at Deutsche Bank seems to be in a pretty stable state. So also announced last night, sort of Christian Sewing is staying on for another 3 years. The investment bank head, Fabrizio Campelli, is also extending his contract by 3 years. There's one person who's leaving, Stefan Simon, the head of legal, who had last year they had a big legal provision relating to an old legacy case around Postbank, and he had a big bonus cut, and now he's leaving the bank. But otherwise, the management board of Deutsche Bank seems to be in good shape, and so that's where Akram is going to join in.
Yeah. Arno Schützer joining us this morning to walk us through the leadership change coming for Deutsche Bank. We thank you so much. Let's go from the banking sector to the technology sector, the video game sector, whatever sector it falls under. Ubisoft gaining in Paris after the video game maker said it will carve out a unit, including Assassin's Creed, Far Cry, and Tom Clancy's Rainbow Six, into a subsidiary with an enterprise value of about 4 billion euros. Tencent also due to invest about 1.2 billion euros to acquire a 25% stake in the new entity, which will hold licenses for the intellectual property of the games in exchange for a royalty. Bloomberg's Tom McKenzie is all over the video game beat, I think.
Guy Johnson's smiling because in his cavernous basement, these are some of the titles that he plays at the weekend. So yes, this is significant. Look, Ubisoft has been misfiring in terms of releases of games. It has a big debt pile. It's been under pressure from activist investors to either go private or be sold, or for Tencent to take a bigger stake. Tencent already has a 10% stake. Now a bit of a lifeline coming through from Tencent then, with this unit, putting in close to 1.2 billion euros. And with that 25% stake. So the analysts, one analyst has already upgraded the stock. You're seeing the move, of course, in the session today. It addresses some of those concerns. The CEO coming out saying this is a foundational step in changing the company's operating model, enabling us to be more agile and ambitious.
Development costs are extraordinary, aren't they?
Yeah.
Absolutely extraordinary in terms of the cost of developing some of these titles. And I'm wondering also whether or not we're looking at a changed world for developers too. How does AI change the narrative? What happens going down the road? Does this feel like a sort of pivot at a crucial moment to take the business off in a new direction?
I mean, AI is a really interesting question in terms of whether that creates efficiencies and erodes some of the costs.
Presumably it must reduce, some of the coding costs must come down, you would have thought.
You would have thought. If they're not seeing it now, then you'd expect them to see that at some point.
Yeah.
And you can code, obviously, at a relatively basic level using, for example, ChatGPT's latest models and others out there, and that coding is possible. You can build simple apps. But whether or not you can kind of get the sophisticated gameplay, for example, of things like Assassin's Creed, the technology seems to be quite far away from that. But there are probably cost efficiencies that they can put in place, at least in the medium to longer term, around that. There is that huge sink of costs when it comes to developing these games, and it's always a bit of a gamble, a bit like building or putting in place funding, I should say, for making a film. You never quite know if it's going to hit and be a hit. Their most recent title, which was delayed, they released it, so Assassin's Creed Shadow, they released it earlier this year. They were hoping to release it last year. It was delayed. Seems to have been quite well received. The other point to this is that Tencent has that huge pipeline, and Tencent will be helpful in getting these games out and more quickly, and also for the mobile devices as well that Tencent is specialising in. And it's also an interesting tell. Tencent essentially acted like a venture capital firm for so many years, investing in dozens of game makers across the world, and then it had to pull its tentacles in on the technology crackdown in China. So it's also indicative of a changing regime in China as well.
I remember this quite clearly. I used to cover video game stocks back in the glory days at
there
Bloomberg.
We go. So you're the expert.
This should be all you.
I'm definitely not the expert, but I do remember, I think it was like 7 years ago when we were talking about Ubisoft, it was the same story of kind of franchises, and they have this issue in the debt pile that they haven't fixed in the 7 years I've been at Bloomberg. Give us a little bit more insight on the Tencent space based on your background in covering China as well. You talk about this regime change as well. Very quickly, walk us through any other players that may be interested in diving in.
In diving into Ubisoft, in diving into developing
you tell me, given this regime change you're starting to see.
Look, Tencent is head and shoulders above the rest out of China. It's one of the major and largest game developers, if not the largest globally, with that pipeline, with those global investments. It has the AI that's investing as well, so it builds out its own models. It's got its application, of course, the WeChat app that's kind of the multi-tool of all apps. But in terms of what this signals, again, I think look to Tencent basically to put more cash to play in the gaming space going forward in Europe and in the US, because the shackles seem to have been taken off, at least to some extent.
New Switch is coming out this summer, isn't it?
Are you putting in an order for that?
No, not yet.
But it's a big. That's a big play for Nintendo.
Yeah.
And in terms of a big bet for Nintendo, is that going to rewrite their fortunes as well?
All right. Bloomberg Daybreak anchor Tom McKenzie really getting into the video game beat. And speaking of games, let's talk about Bloomberg.com. They have a brand new game for you as well. Pointed, the new news quiz for risk takers. You can use strategy and savvy to navigate our handcrafted trivia questions about the week's news in markets, politics, luxury, culture, and more. The more you know, the higher you score. It's already, I can't. This sounds exciting.
Tom really gave this some beans earlier on.
I'm not doing it justice.
And I do wonder whether he's been out there and sort of smashed it. And
we need to have a head-to-head, and I'll be duly humiliated by Guy Johnson's prowess and
Critty always cites herself as being the sort of the A+ student, so I would imagine that she does quite well on these kinds of things.
Well, we'll see. We'll see if that all happens. Well, maybe as we avoid the tariff story, we can digest the video game story. Coming up, we're going to dive into that theme next. Stick with us. This is Bloomberg.
Welcome back. 30 minutes into the opening trade here in Europe. And as you can see, we've got red on the screen this morning. In terms of where we're seeing the movement, in terms of the stock areas that we are watching, certainly you do have a fairly eclectic mix in terms of the percentage losses that we're seeing coming through. There's a real kind of obvious trade, though. In terms of the points, Nestle is the biggest points gainer this morning. Safety, defensives. On the other end of the spectrum, you've got some of the tech stocks, ASML, SAP, Siemens, these kinds of stocks. That is where the weakness is coming through. So a fairly kind of obvious split in terms of what we are watching in Europe this morning. In terms of the split, though, it's fairly even, ups and downs. So you've got 294 up, you've got 299 down, 10 unchanged. So actually a fairly even market in terms of the story that we are seeing this morning. The market, though, all markets, it appear, are waiting for what happens next week, the tariff narrative. How much risk is actually priced into so many of these stories that we watch so carefully on a day-to-day basis, Critty?
everyone's on guard. In theory, to your point, you see it in the equity markets. You sort of see it in the FX market. We keep talking about this volatility. Let me show you one place where maybe it's not showing up, and that's in the high-grade credit space. This is the U.S. high-grade spreads that on a 5-year basis look pretty low. So if we're talking about that volatility, we're talking about that panic. Where is it? Because we are right here on levels that we've seen all the way back into 2021. This red line that you're seeing that's kind of across this chart is the 5-year average. So right now, spreads are trading below the 5-year average, which tells you maybe things are calm on the surface if at least there's panic underneath. But Guy, I think this is crucial because JP Morgan came out with a call in the last 24 hours or so, basically saying that if you were trying to price in tariff risk, that needs to show up in the credit spreads. Basically, investors need to be kind of compensated for that extra tariff exposure. And this goes into the conversation we've been having with equity strategists, even bond market strategists around the world, that said maybe you look at countries and assets that have less international exposure, not more.
Yeah, it's interesting what's happening with credit spreads, though. If you don't get a recession, do you just continue to clip the coupon and take the high yield? Or do we need to fold in some of that tariff risk to broad assets? Peter Tchir is here to answer that question, head of macro strategy at Academy Securities, joining us around the table in London this morning. Nice to see you. Have we priced in enough risk to the tariff story? That's the question basically Critty fundamentally is asking this morning.
And
What's the answer?
I think the answer is no. I think there's still a lot of complacency. You know, you keep hearing, Liberation Day we'll have certainty, and then we can rally on the back of certainty. I think the exact opposite is going to happen. Maybe we try and briefly rally, then people are going to start looking at this and saying, wow, this is actually certain, and we have not come close to pricing this disruption. And I think it's going to feed into the credit markets as well, so I think spreads widen, and I think we have to start pricing in a real recession risk in the U.S. I think there's at least another 10%, maybe 20% down in U.S. stocks.
What's the extreme? How far could they go?
You know, if this continues, I see real deglobalization. And again, most companies were set up to be relevantly, efficient across the globe. So if that destroys, I think we could see a further decline, and I think it could take a long, long time to recover. To me, the biggest miscalculation that I think I'm seeing so far is maybe these tariffs would work if there was a ton of excess capacity in the U.S. There is no excess capacity in the U.S. They're very limited, right? We kind of demanufactured the U.S. over 30 years. Slapping a bunch of tariffs on is not going to create a steel factory in the next 2 months, right? These things are all going to take 3 to 7 years. Even auto plants, right? They're going to be relying on robotics. You've got to get the orders in for the robotics. So I think we are really miscalculating. This deglobalization is continuing, and what I see is kind of a change in the American brand, and I do believe that the U.S. has potentially made a mistake and hasn't benefited the intangibles of what we were in the U.S. and is trading trade flows for capital flows. So I do think the rest of the world is going to outperform versus the U.S., but I think it's going to be in a downward market for the next 2 to 3 months.
You took me right where I want to go, which is the last time we saw the first Trump administration put on these tariffs, specifically against China, not necessarily the rest of the world, the mentality, the roadmap was, when in doubt, buy America. You see it in bonds, you saw it in equity markets, you even saw it in the dollar. The idea here being that the U.S. has that excess exposure and the excess capacity that you lay out. Does the domestic policy layoffs, some of the kind of volatility that you're seeing in terms of not just federal layoffs, but then also the politics within the various states and countries undermine the safety of that bid?
Yeah, I think completely, right? We kind of have almost wars on 3 fronts, right? We're dealing with Russia, Ukraine, NATO. That seems to be causing friction globally. We're dealing with DOGE, cutting jobs in the U.S., cutting spending. That's going to cause some problems. And then the tariffs are causing problems. And then the other thing, I think it's really key that you mentioned China and Trump 1.0. I think countries have figured out a little bit how to negotiate with Trump very differently this time. If you think about Trump 1.0, tariffs, China immediately comes to the door, begging for trade deals. Trump gets to say this. 10% tariff, China says nothing. Another 10% tariff, China says nothing. Trump negotiating mineral deals with Russia and Ukraine. China says nothing. I think they're waiting for Trump to keep coming back to the table, upping the ante, and see what happens. So I think world leaders have figured out how to play him differently this time, and I think that's going to cause problems for the U.S. policy.
So there's a common saying, our guest earlier in this hour has said this as well, that if the U.S. sneezes, the rest of the world catches a cold. It's an argument that the Trump administration is using, and that in terms of capital flows, in terms of assets, in terms of reach, at least in the short term, the U.S. has still more, not only bargaining power, but financial power than the rest of the world. So why would the rest of the world outperform in this scenario?
One, because I think it really has been the American brand attracted capital to the U.S. You're starting to see that. And if you look at the bond markets, right, 2 years ago, you could not get 2% in 30-year JGBs. Now you can. You look at bonds, right, they're almost 10% or 3% in 10 years, right? That creates some alternatives to come out. I think people are actually very concerned about how the U.S. is going to treat capital. Again, if you told me 3 months ago Germany was going to spend hundreds of billions of dollars on military equipment, I would have expected the U.S. manufacturers to soar. They're not, right? Because they want to be very careful where they spend that money. This lack of trust, this American brand, I think was a real thing. We had a lot of intangible benefits. I think some of that's going away. And a little story that I think is interesting and kind of plays out. Last week, the USDA, so the Department of Agriculture, had to give $10 billion of emergency aid to farmers. They have to give the aid to the farmers because their costs have been rising. Guess what a big component of their cost is? Potash and fertilizer from Canada. So you're already seeing impacts, and I think you're seeing a very careless policy, right? They're not thinking these through right away. You know, I am Canadian still. I haven't seen any 51st state announcement. Yep. But if I was going to play this, I would have used Canada to build the manufacturing, right? You need energy. You need all these things. You've had, supply chains in the U.S. set up to use heavy crude. I would have been probably nice to Canada, suck them into the rebuilding, and then maybe screwed Canada. By doing this all at once, I think they're forcing people to turn away. And, the other thing, your previous story talked about, 10 cents back, right? Jack Ma is all of a sudden back. You're seeing China start to rebuild on the world stage. I think what they did with DeepSeek is they showed, hey, we can be entrepreneurs again. I think China's the huge beneficiary of this, as every country who's facing these tariffs with U.S. now turns to China and says, what do we want?
So to back to Chris' point, though, if we do see the U.S. markets coming down 10, 20, 30%, does Europe come down? What does Europe come down in that kind
I would say roughly half. That's kind of my assumption. And I think China
so
can
relative outperformance.
Very much outperform.
What does China do?
Maybe down a little bit, but I think they actually start rising. I think their companies have been undervalued, and if they start coming back and making these deals, people will gravitate to Chinese stocks. So you're going to have to close your eyes. You're not wanting it. And this is something I kind of view China as a trade. Are they becoming investable? Probably not. Still more a trade. But something has to change, and I think the relationship's going globally, or that becomes a trend.
So that bet on China, though, is really a bet on the Chinese government and the fiscal impulse that you're seeing from the Chinese government, the backstops you're seeing in the market. It's interesting to me that you, from a kind of voting with your money standpoint, are more in favor of that bet on the Chinese government than perhaps that bet on the American government.
Again, I'm seeing a very disjointed policy. I'm seeing things that don't seem to work. And it's almost this trifecta, right? You've got this NATO, Russia, Ukraine negotiation that seems to be confusing a lot of people. And then you've got the Doge cuts. And again, I don't think the U.S. economy was in great shape to begin with. I look at the quits rate a lot. I think that's kind of, to me, almost a, crowdsourcing data, because people know at the lower income whether they can quit their job and get a new one. That's already been ending. So I think you're going to have problems on the job front. And all these tariff ideas, yes, if there were 3 to 5 year plans to implement them and rebuild manufacturing, great. I don't see that happening. I think we're going to be scrambling. There's going to be inflation in the U.S. They're going to, I just see this breaking down globally right now.
Retailers continue to buy. The mentality of buy the dip still exists right now. How long do you think it takes for that to disappear? Because every time the market in the States has come down, it's bounced back almost like in a V-shaped recovery. Is that abnormal? 29, you get 1929. It takes 25 years for the Dow to bounce back. Is that going to be what we see this time around? Just which way around is it going to be and why?
I think that's a great point. The one thing, everyone says how bearish everyone is. You look at the ETF flows. There have not been major outflows out of the ETFs. And if you look at, to me, some of the, degen sort of ETFs, like TQQQ, which is a triple leverage QQQ, it now has its highest number of shares outstanding. So people have been buying these dips. And again, we really haven't bounced much. I think all that dip buying mentality gets wiped out. I think it's already been hit once or twice in this round. I think that keeps going down until you actually see true capitulation, like you saw during GFC, like you saw a little bit even during the European debt crisis. There's been a lot of bearish talk. I have not seen that follow through with bearish positioning. I have not seen any degree of panic. I think this is something that has to get hammered home, and maybe next week, if we get a little bounce after Liberation Day or whatever you want to call it, and then we start selling off, that could be the end of the buy the dip in the U.S. And I think Bitcoin, unfortunately, too, gets sucked into this, or fortunately gets sucked into this. And as that comes down, it drags all risk assets with it.
All right, Peter Tchir, head of macro strategy Academy Securities, probably like the most bearish person on the U.S.
cheer this morning
that I've seen. No, not much cheer this morning, but we thank you so much, of course, walking us through the volatility that we are seeing around these markets. Let's stick with that story, because when you talk about the volatility, the consistency around the tariff messaging is also a key piece, especially when it comes to how Europe will react. I spoke exclusively with the former Commerce Secretary, Wilbur Ross, under Donald Trump's first administration about that impact and what they can do. Take a listen.
If a Mercedes is bought in Germany, there's a VAT on it. And in most countries, it's around 25%. But those same countries rebate the VAT on export. So without tariffs on our side, a Mercedes would literally cost less in the U.S. than it does in Germany. Whereas in contrast, since we don't have a VAT or anything else that we can rebate on export, a car shipped from the U.S. pays the VAT. So an American car shipped to a VAT country costs more in that country than it does at home. So VAT is a component of the disparity.
Back to your first point about increasing manufacturing within the borders of the United States, critics of that strategy would say the volatility surrounding the tariff announcements is enough to disincentivize any sort of credibility that a long-term investment in the United States is a good idea. If the economics of tariffs work, do you think the execution of them is a concern?
Well, the execution is a concern, and to my mind, the simpler and more broadly based he makes them, the better.
Well, Secretary Ross, the way Donald Trump is also potentially addressing the deficit and some of the costs around the U.S. government has also been, in addition to tariff revenue, talking about reducing the federal workforce. You've seen DOGE as one example of pretty swift actions in reducing that workforce. Is there anything you would do differently in terms of perhaps the end goals that DOGE has?
Well, they know they have to act very quickly. And the reason is this: some of the measures probably will end up needing congressional approval. And by September of this year, all that the Congress will be focusing on will be the midterm elections. And that means they will be very unlikely after that period to do anything that's controversial. So part of the reason there's a great rush here is the political cycle relative to the congressional election. And that's why you're seeing him try to come very quickly with cuts. Now, going that fast undoubtedly means there will be mistakes, and some of those people will have to be rehired. But that's an unfortunate consequence, but it's inevitable when you're having to travel at the speed that they are.
Wilbur Ross speaking exclusively to Bloomberg, the former Commerce Secretary under the first Trump administration. Guy, to me, what stood out from that conversation was that he's not pulling back or not even throwing any cold water on tariff policy. That's not the concern from him. It's the execution risk. It's the volatility around the messaging. And it's also the swiftness that you're seeing, not just internationally on the tariff front, but even in terms of the DOGE efficiency front, which I thought was relevant ahead of not just Liberation Day, but payrolls next week.
The market just looks for a clear path. It wants to understand what is happening. The on-off kind of strategy around DOGE, around what is happening with tariffs, is what appears to be causing concern. Because if you're a CEO, you want to make a big investment. Yeah, if I know what the land looks like, I can make that decision. But at the moment, I don't, so I can't. And that seems to be what's holding back the U.S. economy so much at the moment.
And that's exactly what Peter Tchir just referenced, right? Yeah. That ultimately, if you know how you can navigate this market, it's way, way easier to do it. With that same vein in mind, that investment in the United States in mind, let's take a quick look at that pre-market, because one of the major movers this morning is actually U.S. Steel, which is now looking and getting a little bit of a sign-off of a massive Nippon Steel investment as well. This is the company in Japan that has basically been barred from investing and taking over U.S. Steel as a whole in the United States, but is still looking to make an investment of something like $7 billion. So that's pushing the shares higher by about 7% this morning. Lululemon also taking quite the beating. That is a tariff story. That's a Canadian activewear story as well, down about 10%. So they're going to be one on the front lines of that. And then, of course, Apple and Meta looking at fines from the European Union going into next week, so already selling off as well.
Yep, tech under pressure. It's going to be interesting to see. Those fines, I think, are fascinating. How far does Europe go on them?
Yeah.
Because it could be just another kind of catalyst to get the Trump administration riled up. And you do wonder whether or not, therefore, there's some politics around with the scale of those fines. We'll find out about that next week. We are going to return to Europe in just a moment. We need to talk about what is happening in the bond market this morning. European yields under pressure, as you can see. So the bond market catching a little bit of a vid this morning. We've seen very soft French CPI data, Spanish inflation data coming below expectations as well. What does it all mean for the ECB? Well, the market's certainly pricing in greater chances of cuts now. We'll talk about it next. This is Bloomberg. 49 minutes past the hour. Let's call it 50 minutes past the hour. This is what European markets look like this morning. The FTSE 100 is actually in positive territory. Some of the drug stocks are doing well. Astra's giving certainly a big push to the upside this morning, adding the most points by some considerable margin. Defence stocks and oil stocks are actually where the weakness is coming through, alongside a few banks as well. The banking story takes us to what we are seeing with the bond market this morning and what we're seeing in terms of ECB pricing. So traders lifting ECB easing bets. Something slightly wrong about that. We've lifted easing bets. Anyway, there's going to be cuts, potentially more cuts coming through from the ECB. We've seen French data this morning, Spanish CPI data coming through, softer than anticipated. The French data really soft. Meanwhile, markets, of course, are waiting at US PCE data a little bit later on as well. So we're going to be talking about US inflation as we head into next week, when we're going to be talking about tariffs and jobs. So we've got it all covered around the table this morning, I absolutely promise. Valerie is here, and we've also got Bloomberg's Western Europe economy editor, Zoe Schneeweiss. So I'm going to start with you. So the data this morning, France first, then Spain, both soft. The market is repricing the ECB as a result of that. But how long is this going to last? We've got German data Monday. Talk us through the kind of the volatility we're seeing in market pricing expectations.
Yes, so the ECB repeatedly says that all they care about is data, that they're data dependent.
Don't we all?
So as we all. These inflation numbers, the ones today for Spain and France, and then on Monday, Germany, Italy, and on Tuesday, the euro area as a whole, those are the last big data point we get before the April 17 rate decision. So really, these are the numbers that should be moving things. These are the numbers that should be deciding, do we cut or do we hold? Now, the issue, of course, is that next week we have tariff week. We have the week that April 2nd, what is it called, Liberation Day, as Trump terms it, where the ECB, where this barrage of tariffs will be hitting across the world. And now the question is, will the ECB retaliate? Because if they do, that is inflationary, and that, again, could change the whole trajectory of what they do next.
All right, so Val, dive in here, because ahead of that Liberation Day, we still have a little bit of data to digest, including the PCE today and a few other figures into payrolls next week. How does that all fit into this picture?
Yeah, at least for the Fed side of the equation, we've seen a market reaction to the soft data in Europe today with Bunds rallying. I don't think we're going to see quite an outsized market reaction to PCE data today. That being because we've heard from the Fed that they are on a path of caution, a path of wait and see. And with this data reflecting CPI and PPI from February, I just think that the market is going to be in a more of a wait and see mode. They really want to see the impact of tariffs, and we're not going to see any hint of that today. But we could see perhaps a surprise when it comes to personal spending, maybe another hint on the consumer, with consumer confidence declining, and retailers, from Lululemon, from the likes of Walmart, from the big box retailers, warning on the outlook for the consumer. Maybe we get a hint of that today, and that's what the market tends to focus on instead of the inflation hint.
But we've got payrolls coming. Payrolls are coming next. The whisper number at the moment is 77. If you get a weak number, it says below 77. How does the market react to that? Because that's going to change Fed pricing. We talked about ECB pricing. That's going to change Fed pricing.
Exactly. I think the labor market is what's going to change the Fed pricing. If we look at what's priced in for May, the market does see the Fed being on pause again in the May decision, but a weak labor market print could really change the dynamics of that. We know that they're going to wait and see mode on inflation, but if we get a very weak payroll print, let's say a negative payroll print, that's really going to start pushing up the ECB bets, or sorry, the Fed bets on easing
probably
in May.
ECB bets as well.
Yeah, maybe.
Well, Zoe, you dive in there on those ECB bets, right? I mean, if the U.S. is so focused on this kind of labor story more so than the growth story, Europe doesn't have that same problem.
Exactly. We don't have a dual mandate. The only thing we care about is inflation. Obviously, economy does play in, because if the economy is weak, then that at some point that will feed through to prices. Overall here, we have the situation, though, that central banks across, it's not just the Fed that's in hold pattern right now. Central banks across the world are holding. We just had Norway hold yesterday. Yeah. We had Sweden hold last week. The Swiss sort of did this one security cut last week. But still, overall, everyone's on hold. So the ECB doing anything is quite brave, really, and it would really be required here is that inflation is quite weak. And overall on that, one of the things that we need to look at there next week will be the services number. That's more important almost than the headline number. The headline number we know has been creeping towards 2, but the services number is still about like 3.7, which is quite massive.
Well, so it's interesting because services could be targeted by the European Union.
I was just about to say that, but Zoe, let's bring it back to that that point, and that is the ECB. I know they can't say this officially, of course, on the record, but at some point does the ECB not only have to factor in Liberation Day and the tariff impact as well, but perhaps what the Fed is doing, given that they have been on the same page in the past?
Exactly. That's what we call it, the gravitational pull of the Fed, that whatever the Fed does, all other central banks look to the Fed, and the ECB can't completely ignore what the Fed is doing. So that's the question also with if the Fed starts holding, or even if there's suggestions that it continues holding, and if there's suggestion that it might even hike, although I don't think anyone's betting on that right now, that just does change the whole trajectory for the ECB.
Susan Collins was talking about it's kind of on hold all year. So there's the kind of very cautious stance being taken. They don't know yet.
Yeah.
So they're going to wait and see. Okay. Valerie, thank you very much indeed. Zoe, thank you very much indeed. Busy week coming up. What are you doing at the weekend?
What am I doing
at the weekend?
Oh, that's challenging. Well, I've got a couple of options. I hear a solar eclipse is on the radar.
Only a partial one.
Still a solar eclipse. I hear it's Mother's Day.
Only in the UK,
Only in the UK, this is true. American Mother's Day doesn't happen till May. And then I think some stuff that's on your radar. March Madness, the Rugby Sevens.
March Madness, less so. I think that's basketball, isn't it?
Yes. Sure. I think. Sounds familiar.
You're hiding your bracket there somewhere.
My bracket, it's on my Bloomberg. The Rugby Sevens is good. So Hong Kong, new stadium, this fantastic new stadium. It has started. We've all been waiting for this. Hong Kong Sevens is an amazing thing. So you can watch that on TV. The Sevens is such a great game. Had Rosalind Park this week. That was fantastic as well. So there's some great sport coming. And look, that's the video.
Someone was telling me that there's a singer in the stadium coming up. Is that right? Is it Coldplay or someone is performing? A singer.
Coldplay.
I
have very mixed feelings about Coldplay, but that's neither here nor there.
Coldplay is. I'm struggling with culture on this Friday morning.
My wife is a fan. Anyway, that wraps things up for us. Have a great weekend, folks. I hope you enjoyed this week. Next week is going to be quite the week, so make sure you tune in. The Pulse is coming up next. This is Bloomberg.